Welcome to LR Reports. This episode is based on institutional research published by a leading global financial firm. We focus on the core investment thesis, key assumptions, and material risks outlined in the original report.
Welcome back to the deep dive. We are moving immediately into the institutional briefing format today. We're cracking open a major piece of sell-side research on the outlook for US equities.
That's right.
Our mission is to take this dense, data-rich report and really distill its core and, I think, out of consensus message for you.
Okay, so for the record, we are reviewing the Morgan Stanley US Equity Strategy Report. It's titled 2026 US Equities Outlook. The Rolling Recovery is Here, and it was published on December 10th, 2025.
And you said this report introduces a definitive, and I think importantly, a counter-consensus view on market rotation for the next year.
It really does. It's a big call on style leadership.
That's the key, right?
Yeah.
Counter-consensus. We aren't just talking about a continuation of the narrow leadership we've all seen.
Not at all.
The core argument here is that the market is about to enter a period of definitive breadth expansion. So let's unpack this fundamental thesis right out of the gate. When they talk about the rolling recovery, what specific mechanism are they describing?
They're essentially drawing a line under the past 3 years. The thesis suggests that what we experienced wasn't one big recession, but a 3-year rolling recession.
A rolling recession.
Exactly. Where weakness, or you could say capitulation, just cycled sequentially through different sectors of the economy.
And they have an end date for this.
They do. They say it concluded pretty definitively around April 2025. That period of capitulation, they even call it Liberation Day, marked the end of those recessionary pressures.
So the idea is that this transition signals the start of a new, broad-based bull market.
Yes, and specifically for the lagging segments of the index, the ones left behind.
Right. So the weakness that hit, say, manufacturing in 2023 has now fully cycled out, and those segments are ready to drive growth. This is a classic cyclical play. What early cycle elements do they point to that validate this is happening now?
Well, they cite 3 classic drivers that are all lining up at the same time. First, you have compressed cost structures. Companies have been laser focused on efficiency, and that sets the stage for some really powerful positive operating leverage as demand returns.
Makes sense. What's the second?
Second, they point to a historic rebound in earnings revisions breadth.
Okay, let's pause on that phrase for a second because it's a critical indicator. When analysts talk about a rebound in earnings revisions breadth, what are they really signaling to you, the listener?
It's the sentiment turn. It's a measure of the percentage of analysts raising their EPS estimates versus those who are cutting them.
So a historic rebound means?
It means the overwhelming trend is now upward. It shows analysts have growing confidence in forward visibility, in the durability of this growth cycle. It's usually a very early sign that recessionary fears are priced out.
That's a great explanation.
Yeah.
Okay, and the third element?
The third is simply pent-up demand. I mean, across wide areas of the economy, investment and consumption were just suppressed during that rolling recessionary period.
Creating a reservoir of demand.
Exactly. It's ready to be unleashed as confidence and balance sheets stabilize.
Now, we need the hard evidence. Did the third quarter 2025 results actually back this up? What data points signal that the recovery is truly broadening out?
So Q3 2025 gave them the definitive proof. The S&P 500 showed a 2.2% revenue beat rate.
Which is
It's double the historical average, so widespread strength. But the most revealing data point, the real aha moment for the report, was the performance of the average company.
Okay.
The median stock in the Russell 3000 delivered 8% EPS growth.
And that's significant because
They explicitly call that out as the strongest growth seen in 4 years. It confirms the recovery isn't just about the top 5 names anymore, it's spreading.
that median stock performance is compelling proof. Okay, let's shift to conviction. This outlook led them to raise their S&P 500 price target to a very aggressive 7,800.
It is aggressive, and that target incorporates higher than consensus EPS forecasts. They're specifically targeting 2026 EPS of $307.
That's a 17% growth rate year over year.
It is. It's a headline number for sure. And the report defends it with 3 main drivers.
Let me guess. Operating leverage is one.
Yes, we've covered the return of positive operating leverage and pricing power, but they are also significantly increasing the expected contribution from AI.
Oh, interesting. How much is AI expected to add to those earnings?
They now expect AI-driven efficiency gains to add 40 basis points of net margin expansion in 2026 alone. That's a material increase from their prior estimates.
So the benefits of all that tech investment are now actually hitting the bottom line.
Across a much wider range of companies, yes.
And these earnings aren't happening in a vacuum. I imagine fiscal and regulatory policy is playing a role here.
A large role. They assume an accommodative backdrop. They specifically cite the return of policies like upfront R&D expensing and 100% bonus depreciation.
Which were reintroduced through the OBBBA, right? The One Big Beautiful Bill Act.
That's the one. And these policies are enormous cash flow tailwinds. They're designed to accelerate that public-to-private growth transition.
Okay, so $317 in EPS is the engine. But a 7,800 target implies a forward PE of 22x. That 22 times multiple feels stretched. Where's the support for that?
It does feel stretched. The framework they use rests on how rare multiple compression is under very specific conditions.
What are the conditions?
Their analysis shows that big multiple compression is historically rare when two things are true. First, EPS growth is above the median, which they define as 7 to 8%.
And they're calling for 17%.
Right. And second, monetary policy has to be accommodative. Since they expect both, they argue the conditions are firmly in place.
Which brings us right to the core monetary policy assumption, the run-it-hot playbook. How accommodative do they really expect the Fed to be?
More accommodative than the market consensus implies. This view is based on policy and data. The administration's policy goal is to run it hot, to get high nominal GDP growth.
And the data gives them cover to do that.
That's the idea. They anticipate moderate weakness in lagging labor data, which gives the Fed the justification it needs to ease rates and maybe even expand the balance sheet.
Is there a historical precedent for this?
A powerful one. They note that valuation expands 91% of the time when the Fed funds rate is down year over year and earnings growth is above average.
It's an almost textbook setup for multiple expansion.
It is.
So if the earnings story is that strong and the Fed is on board, it completely changes the investing map, which leads to the biggest tactical call, the style dynamics.
This is the centerpiece of the whole thing.
They're upgrading small caps to overweight relative to large caps and expect cyclicals to outperform defensives.
Yes. This is the big rotation call. Small caps are your classic early cycle outperformers. They're highly geared to positive operating leverage because they've been cutting costs so aggressively.
And what was the trigger for the upgrade?
The visible turn in small cap earnings revisions was critical. But what's maybe most striking is the valuation asymmetry.
Walk us through that valuation point. What's the price discrepancy?
Small caps are currently trading at a significant 7-turn valuation discount to large caps on a forward PE basis.
7 turns. That's a massive gap.
It is. A spread that wide usually implies a huge amount of embedded pessimism. It suggests the positive tailwinds, lower rates, operating leverage. None of that is priced in.
And this ties back to that political context you mentioned, the need to rebalance the K economy.
Absolutely. The policy levers, deregulation, lower rates are all aimed at boosting smaller businesses and the average stock, the ones that were crowded out from 2022 to 2025.
We can't talk about a 22x multiple and large cap dominance without the 1999 bubble comparison coming up. How does the report sort of soothe those anxieties?
They provide a direct 3-part contrast that focuses on quality.
Okay.
First, today's top 10 S&P 500 weights have median operating margins over 20% higher than the top 10 names did back in 1999.
So they're just more profitable businesses.
Fundamentally, yes. Second, the median free cash flow yield for the median large cap stock is almost 3 times higher today than in 2000, just dramatically higher cash generation.
That operational efficiency point is key. What's the third contrast?
The macro backdrop is inverted. In 99 and 2000, the Fed was hiking rates to curb speculation. Today, the central forecast assumes the Fed is cutting and staying accommodative.
The clarity on the quality difference is critical. Okay, let's move to the tactical sector calls. They identified 4 overweights: financials, industrials, consumer discretionary goods, and healthcare. Let's start with consumer. It got a double upgrade.
It did. Consumer discretionary goods to overweight. And the thesis here is basically reversal. Relative performance is near all-time lows.
So extreme pessimism.
Exactly. They expect a significant shift in wallet share back toward goods from services as goods pricing stabilizes. And crucially, the goods sector is more insulated from the wage pressures hitting the services sector.
And healthcare, often seen as a quality growth area.
Upgraded to overweight, it's primarily because of rate cut exposure and M&A. Biotech, in particular, historically performs very strongly 6 to 12 months after the first Fed cut.
And the valuation is attractive.
Very. It's in the bottom 6 percentile historically, so it's a compelling growth and quality play.
What about the two reiterations that reflect cyclical strength? Financials and industrials.
Financials remain overweight, benefiting from two main things. First, a major M&A rebound. Q3 25 announced volumes were up a massive 43% year over year.
Wow.
And second, easing credit conditions. The Senior Loan Officer Survey points towards strong commercial and industrial loan growth into 2026.
And industrials are the direct beneficiaries of the broadening economy.
Absolutely. Industrials remain overweight. They are perfectly positioned for market broadening, the turnaround in the ISM, and all the structural tailwinds from the domestic capex cycle.
Reinforced by that bonus depreciation policy.
That's the one.
Now, before we move to risks, there's a specific nuance within tech. It's not a uniform overweight call.
No, it's a relative preference. They prefer equal weight software over equal weight semis.
What's the rationale there?
It's shifting earnings revisions breadth. Software revisions are turning higher, but for semis, positioning data is a concern. Exposure is really elevated, 99th percentile versus the 2010 average.
While software is still under-owned.
Comparatively, yes. It provides a better tactical entry point.
Okay, let's wrap with the risks. The whole bull case rests on the U.S. economy being in an inflationary regime. What does that really mean?
The core assumption is that we're in a period marked by hotter but shorter cycles that will likely last for years.
And why is that?
Because the government needs nominal GDP growth, targeting maybe 6 to 7%, to run way above the cost of borrowing. It's about managing the high debt to GDP ratios. Running hot isn't an option, it's a fiscal necessity.
That fiscal reality drives everything. But what are the key near-term risks that could derail this outlook? Where could a portfolio manager get stung?
The report identifies 3 immediate risks. First, and this is the most potent, is the Fed just not delivering, not being as dovish as expected.
Okay.
Second, you could see tighter liquidity headwinds persist in those high momentum areas, which would limit the breadth expansion. And the third is a timing risk.
A timing risk.
Yeah, that delays in the labor data confirming weakness could delay the Fed action, pushing out the start of the whole cyclical rally.
And what's the long-term risk? The bear case, where the whole thesis just breaks down.
That's centered on the run-it-hot policy being too successful.
Okay.
It leads to an unsustainable inflationary impulse that forces the Fed to reverse course and unexpectedly hike rates in late 2026. That would trigger multiple compression, and EPS growth would drop from 17% down to just 5%. It would shatter the whole thesis.
That brings us to our final summary. The central narrative is a broad earnings recovery. That aggressive 17% EPS growth driven by corporate efficiency, AI, and accommodative policy. And the core tactical call is a definitive shift towards small caps and cyclicals.
What's fascinating here is how the inflation theme changes as the cycle matures. The report notes that over the past 5 years, gold and crypto have been pretty successful hedges for that run-it-hot thesis.
Right, defensive inflation hedges.
Exactly. But now that the recovery is expected to broaden into cyclicals, it raises this really important strategic question for you to consider. If this rolling recovery materializes, should cyclical equities be expected to outperform gold in 2026 as an offensive inflation hedge? The defense shifts to offense.
A compelling frame for thinking about shifting risk and reward as we move into this new cycle. Thank you for guiding us through this critical deep dive.
It was a pleasure.
And thank you for joining us for this institutional briefing. We'll catch you on the next deep dive.
You have been listening to LR Reports. This content is for informational purposes only and does not constitute investment advice.